Hello all and welcome back. All right, I need to start off by telling you that at the end of this video, I plan on getting somewhat controversial with respect to inflation. So make sure that you stick around for that because there are many on social media right now who claim that they've just got it so bad. Well, what I'm going to do is I'm going to compare the late 80s and early 90s, like from when I got out of high school and tried to get into college and all that stuff. I'm going to compare the late 80s and early 90s to today. And then you can go ahead and tell me who had it worse. Spoiler alert, the only difference between the 80s and 90s and now is we didn't have such a divided country politically speaking, and we didn't have news networks that are trying to profit from fear and anger, and we didn't have social media sites pouring fuel on the fire, and we also didn't have like 10 years beforehand where everybody had it so dang good. So that was the difference between then and now. But believe me, we had all the inflation then that we have today and more. And you know what? Everything turned out all right. But you know what? On the less cynical side, and some might even say the brighter side, let's have a look at my favorite stock. Settle down, Mike, settle down. Amazon. Yeah, so Amazon is my very favorite stock in this entire market. And the reason why I like it so much is I think it's very mispriced and it's not fully understood by analysts just yet. They'll start hiking up their price targets as they start figuring this out, just like they did Nvidia. As Nvidia stock went up, they kept on raising their price targets. They're going to do the same here to this one. I'll show you in valuation wise why I think this one's so undervalued, but the bull case for this is that their margins are expanding. I mean, they've pretty much grown as a company. They've built a lot of warehouses. Their capex is shrinking, and so their profit margins are expanding on their e-commerce side of their business. Now, also, their profit, the growth of their Amazon Web Services is also more than what analysts had expected. And then also, I think that they kind of accidentally fell into this one, but their digital advertising revenue is, it's also very high profit, but it's, I think, something they didn't expect to grow like this, but it is. So they're making a lot of money off of that. But another place that I don't think they expected to find money, it's like these guys fall backwards into money, left, right, and center, kind of like myself. They just kind of fall backwards into money. And one place that they're falling backwards in now seems to be potentially with this TikTok ban. So let's go ahead and have a quick look at a very short video between Sarah Eisen and the old channel mascot, Kate Rooney. And we'll see how they can actually benefit from a TikTok ban. And then we'll go ahead and look at the valuation and see where my price target is for this stock and where really everybody should have it.
Amazon has been expanding into a new corner of e-commerce, social media shopping. The company may stand to benefit if TikTok does indeed get banned. Our Kate Rooney joins us to explain. What are they doing here, Kate?
Hey, Sarah. Yeah, so Amazon might not be the first name that comes to mind around social media shopping, but after a partnership blitz last year, Amazon is now embedded in the biggest social apps. A lot of this happened within 6 months last year. Amazon teamed up with Pinterest in April of 2023, then Facebook, Instagram, and Snapchat all in November. The agreements put Amazon products into social feeds and then lets users link Amazon accounts to then make purchases. This is for both core Amazon products and some of the third-party sellers out there. And then amid those deals last year, the e-commerce giant was also taking a page from Instagram and TikTok for its own mobile app. It launched Inspire in 2023. So this lives within the Amazon app. It looks a lot like Reels. And these are actually Amazon products. So they're being promoted by influencers. They've been partnering with content creators since 2017. And part of this, guys, is defensive. So scrolling and shopping, as you guys were talking about with Ulta and TikTok, it's a bigger slice of e-commerce that Amazon does not want to miss out on. Insider intelligence estimates social e-commerce will grow into $100 billion market next year, up from $67 billion last year. Younger generations are driving it. A quarter of social shoppers are between 25 and 34. That's according to eMarketer. Instagram tends to bring the most purchasing power. TikTok, though, not far behind. It's pretty much tied with YouTube. I talked to Mark Mahaney over at Evercore about the potential impact on Amazon if TikTok does get banned. He told me, quote, to the extent TikTok is taken off the table, it could be an incremental positive and means more opportunity for Amazon because of some of these shopping partnerships. Mahaney points out that the social strategy is driving both sales and advertising for Amazon. Guys, back over to you.
So I'll bet you that a few years ago, Amazon had no idea they would be making money off of social media influencers in the way of advertising and third-party retailers and things of that nature, but it appears that they are. And so this is just another way that Amazon is just making money. Now, why do I think that they're so undervalued? Well, let's go ahead and look at their historical price to earnings ratio, where they're trading at now, and what I believe the price should be on this stock. So right now it's selling at $174.57. The price to earnings ratio on this stock right now is 60, but they always go off a forward PE. The forward PE of this stock is 42.18. If we look over at their historical PE, where this stock trades at, generally speaking, and I would argue that the growth is at least as good now as it's basically been in the last, like, I don't know, 15 years. It's as good now as it was then. And you can see that right now it's trading at that 60, and here, it's been trading at 52. It's been undervalued. But if you look at it prior to where it was before, you can see it generally trades somewhere in the, I would say, the 50 to 90 range. It settles a lot in the 70 range, but for the purposes of this valuation, we're going to call it 65. So what we do is we go over here to the price of this stock right now, which is 174.57, and we divide that by the price to earnings ratio, the forward PE of 42.18, and we would see that it would have a price per share of $4.13. If we multiply that number by the price to earnings ratio that this company always sits at, which is roughly 65, we can see that the target valuation of this stock is $269. What I'm saying is a year from now, this stock should be this price. So then that means that we have about a 54% price increase over today. I think that's a generous return on a stock, and that's the reason why it's my favorite. And plus, it's not very risky, I don't feel. I think that the stock is a very, it's a pretty conservative, safe play on the stock market relative to, a lot of other things you could be into. So yeah, I'm loving Amazon now. So I assume that we've all been making a lot of money this year in the market. And, for my part, I've been right on the mark with respect to the market direction for pretty much as long as I can even remember. And that's because this market has been, very predictable because it's very centered around the macro. If interest rates go up, then you go into mega cap tech. That's the safe play. They're the ones with all the free cash flow staying around. They're the ones that don't need to borrow money from anybody. If interest rates go down, you go into industrials, banking, maybe small caps, basically anything other than mega cap tech stocks. We have the summer coming. We know that the fuel prices go up, and what do you know? The energy sector has been raging because we know that gas prices go up in the summertime. And I understand that it's not traditional to trade around your stock positions and just sell in and out of the market. But with 5.4% interest rates on 1 month treasuries, there's really, I don't think, any harm in doing that, because you're still getting money. You haven't really sold out. You just aren't seeing any sort of like tailwinds. You can't figure out where the next bit of good news is going to come from. So in the meantime, why don't you get a 5.4% annual percentage rate for your cash? And it's why it's this treasury rate. It's the reason why right now the rich are getting richer. And it's the reason why I don't mind going into treasuries, because I'm just getting all this for sure cash until I get my tailwind. And I'll show you where I think I'm going to get my tailwind here later on in this video. But for now, let's go and see how much Warren Buffett would be making on these treasuries if he was to put all of his money into these treasuries. So a quick Google search of Warren Buffett's cash on hand will show that Berkshire Hathaway has $157.2 billion. If they didn't invest it in anything except for treasuries, what we would find is that the government is paying these guys an awful lot of money every single month to the tune of, $8.4 billion a year. But if they're paying it every month, Warren Buffett stands to make $707 million every single month, just coming from the United States government. They're paying him this if he puts this money into 1 month treasuries. Microsoft is doing the same. Apple's doing the same. All these companies are doing the same. It's the reason why in this interest rate environment, as soon as if you suspect the interest rates are going up, that a lot of people push their money into these safety plays. That's why Microsoft made so much money last week. Now they had this little AI thing that came out, but I think more than anything, it was that hot inflation print, the thought that the interest rates were going to go up, and the knowledge that they have a lot of cash on hand and probably going to make an awful lot of money in the short run. It's also one of the reasons why it's believed that the Fed simply has to cut interest rates. This is an awful lot of money to pay for our debt. I mean, the debt to GDP right now is just not very good. So they've got to lower this interest rate to get this price down that they're paying out to everybody. But it doesn't mean that I'm not taking advantage of it. So I said that last week that I was going to sell out of the market, not entirely, but, keep very little bits of equities and go more into short duration fixed income if the inflation print came out hot as expected by consensus. And in fact, it did actually come out just as hot as the consensus had expected. It come out right on target. And one of the things that was pretty nice that happened was that on the day the inflation print came out, I noticed that interest rates went up, but the stock market also went up. So when I sold out of a lot of my positions, I actually made money on the way out as well. And then, of course, it came down as the week went on. We had the PPI number that come out a day later. That was a bit deflating. And so the market just continued its downward trend. But in the meantime, I did get out on Tuesday for the most part, and I went into treasuries. Now, it's not that I'm being bearish. I mean, I am not a market bear. No one has ever made money in the stock market in the long run by being a bear. It's just that, if you pay very close attention to the market as I do, it's kind of easy to predict the general market direction. And, and then just kind of patiently wait around for your next tailwind and prepare for the next market move higher. Now, of course, I could be wrong, all of this could be wrong, but I just think that the next tailwind that's going to come is going to come from right here. It's going to come from mega cap tech earnings. So it's my belief that the next market tailwind is going to come around when these earnings start coming out for these mega cap tech companies. We have a very short memory in the stock market. We kind of forget that all of the earnings growth that happens for the S&P is coming from this small handful of companies. So our next big market tailwind is going to happen here around April 25th. If you look at also, this is for the date that Amazon reports. If you look at Google, they all report at about the same time. Google will be reporting here well, they haven't announced their earnings date yet, but it'll probably be around. They probably wait on when Snapchat's going to release theirs because Snapchat tends to doom them. Like Snapchat puts out earnings and then it sinks the Google stock. But I digress. Meta puts down their earnings here on April 24th. Microsoft is going to put out their earnings on about April 30th, and Apple comes out with their earnings on May 2nd. And NVIDIA usually comes a few weeks after everybody else here, and they'll be putting out their earnings. And believe me, everyone's gonna have their eye on this one because this is a make or break for the market here. And this one comes out on May 22nd. But all in all, I can see that the next big catalyst for the market is going to be these mega cap tech earnings. And I'm going to show you what's going to happen in the next inflation print here and why I believe this is the next big tailwind for the market. So we got a little time, so I might as well make some money while I wait. So I'll just stay in these treasuries for about the next month. Let me go ahead and show you my portfolio and what I had going on now since I've adjusted for these for just the next month. So my portfolio now consists of basically, I got treasuries. I got about 264,000 of those. So over the next month, with 264,000 treasuries, just while I wait, I would expect that I'm going to make an annual return of $14,256, but a monthly return of $1,188 just while I sit here in these treasuries. And you can see that I'm got about 200,000 maturing on the 9th of April. And I've got another 64,000 maturing on the 11th of April. And the reason why is I want this money. I want it available to me, a couple of weeks before these earnings start coming out. My other positions are, you can see that I own about 200 shares at least of Novo Nordisk. I own 100 shares of I sold out of my Amazon position, but then I had to get back in. I don't know if you've ever left the house without pants on, but it's kind of the way I felt when I sold at Amazon. I'm like, why don't I own this? But in addition to having 100 shares, I also sold a put on Amazon for another 100 shares. If it goes down to that by the 22nd of March here, I'll go ahead and buy another 100 shares. If not, I'll go ahead and keep this $168. Now, in addition to this, I also have 100 shares of Shake Shack, but that thing, it doesn't really fall down. I'm just afraid it's going to have that really surge upwards. So I'm really afraid to sell covered calls on it at the price that I'm going to get for covered calls on Shake Shack. Sometimes it's worth it and sometimes it just isn't. So I have some Shake Shack, Amazon, Novo Nordisk, and I bought 4 puts against DWAC, of which I'm up, I guess, a total of $49. Those expire on June 21st. So how has the market performed since the inflation print came out on Tuesday? Well, let me go ahead and show you here. You can see the S&P here on Tuesday. It's about when I sold out. I got really lucky that the market didn't crash on that day, but I wouldn't say I sold out, but you know what I mean. I got mostly out into treasuries, and I'm going to wait for that tailwind in April. And I got out about right here, and since then the S&P went down only about 1%. So it hasn't gone down that much, but I got out near the top, and I'm kind of waiting this thing out until we get some more news that in comparison to, say, the NASDAQ, the S&P has performed slightly better than the NASDAQ, and the Dow Jones, it has performed roughly the same as the Dow Jones. And if you compare it to the equal weight S&P, the S&P is a market cap weighted, the bigger companies get more credit, but equal weight would be RSP. If we compare it to that, we can see that the equal weight was down. And that makes sense because as interest rates go down, you're going to see more of the money flow into the bigger companies. And they don't have to be tech. I mean, it could be Caterpillar, John Deere, Home Depot, Lowe's, and the like. It could be anybody, but it's going to be your bigger companies. It's going to be the ones with cash on hand if you see interest rates rising. So the equal weight's not going to perform quite as well. And on that note, we'll see that the market breadth, they talk about they don't like everything like consolidated into just a few stocks in the stock market. They say it's unhealthy for the stock market. And so if we look at year to date on a lot of these different sectors, we can see that I've already put them out here, but that the S&P, which is this yellow line here, is up 7.89%, but the industrial sector, on the back of that, that infrastructure bill that was signed, industrials have been doing quite well. Financials have been doing about as well as the S&P. The tech is up about 9.7%, but we can see that relative to the S&P, a lot of sectors are doing just fine, whether they're industrials, financials. I'm sure the home builders are doing just fine. The home builders are up 7.6%, and they're doing this without the participation from Tesla, which is the worst performing stock in the S&P 500, but you're not getting anything out of Apple. Apple's down 7% year to date. Google is probably pretty flat here year to date. It's up 1.87%, so they're not getting any help from that. But oddly enough, if you actually make a typo and instead of Apple type in Advanced Auto Parts, Advanced Auto Parts is up 32% year to date. So you can see that there's a lot of different companies catching fire right now. This move upward year to date has not been just entirely on the mega cap tech. No matter what happens, whenever you turn on the TV and see what they're saying, that's just not the case at all. And to further illustrate the point about why I think that the stock market's going to go up when on these mega cap tech earnings is that really all the earnings growth is coming from these stocks. Now, this is the Magnificent Six versus the rest of the S&P. They've eliminated Tesla from this because they have been the worst performing stock in the S&P 500. But you can see that the other 494 have had about negative, 7% growth, while the Magnificent Six has represented about 65% earnings growth. And then in Q1, the one we just had, the rest of the 494 have actually been negative, while the Magnificent Six has been up about 40%. Now, we do expect this to change as time goes on to where actually eventually the 494 will actually outperform the Mag 6 on a growth basis. And that could explain some of the rotation that we were just talking about into XLI and ITB and XLF and the different ETFs that represent the other sectors of the economy. All right, so right here, this is where I'm about to get old cantankerous old man on you and go out and shake my fist at the clouds and tell you about how good you've got it because inflation's not as bad today as it was back in my day in 1987. So we just had that CPI report that just came out. We're showing that our year-over-year increase in inflation is 3.2%. As I talked about in the last video, I didn't expect the food was going to go up because it was up so high last month. I thought it would come down basically in line where it always is, 0.2, but it actually was flat. Energy was up a bit as we could expect. We're getting the summer months coming. Oil prices start going up. We start revving that up. And so this was up a little bit. But we could see that year over year, energy is actually negative now versus last year. Food is up 2.2% over last year on an inflation basis. Electric bills looks like they're setting you back 3.6% more than they did this time last year. All in all, energy services are up 0.5% over last year, but yet a month-over-month decline from January to February. Utilities are down 8.8% over the past year. All items less food and energy are up 3.8%. But the bulk of all of our inflation seems to be coming right down here from this services sector. Our transportation, those would be your airplane flights. These things are way up over last year. They're up 9.9%. Shelters up 5.7%. And services less energy is up 5.2%. So it's basically that our services are up. And if you look at our things here, like apparel, it's even. It's at 0% this year versus last year. That was way up month over month, this month versus the previous month. So a lot of the inflation you can see is not coming from goods. It seems to be coming from services. And we also talked about this last week, that I expected the medical care services would come down, the medical insurance would come down, and it has. And it's up 1.1% year over year. Now, when we look at CPI year over year, now the CPI for all is going to be in this blue line right here, where right now it's up 3.16% year over year. And the PCE, which is the one that the Fed looks at, it's up 3.76% year over year. Now, we can see that here from say January or even February 2020, after recession. Of course, a recession, the prices, you get deflation during a recession, so you'd expect this drop right here. And so you can see it says January of 2020 up to June of 2022. That's been a pretty shocking increase. This would be the reason why people didn't feel so good about life or economy. They were down about 0.2% inflation and then went quickly up to 8.98% inflation. We've come down here, and what we seem to have leveled out right just above 3%, and we seem to be trading sideways. So why would we be trading sideways? Why is it not just coming down more in a straight line? Well, I believe this has a lot to do with this right here. It has to do with wages. Companies are passing on the cost of employment onto us, basically the consumer. And you can see the blue line here is the wage increase, and then down here, the black line, that is inflation. So you can see that wages are far outpacing inflation at the moment. And it's the fact that this wage inflation is out there, that's what's keeping this this number here from coming down, say below 3%, down to like in the neighborhood of 2. So the question then becomes, all right, how bad have we got it? Like I said, back in 1987, when I graduated high school in 1987, I was pretty quickly out on my own. But let's just say January of 1988 until, January of 1992. Let's give it actually, let's do 93. Let's do a good 5 years, because we're going to compare this to 2019 to today. We could see that a dollar, and this is just coming from the Bureau of Labor and Statistics. They just have a calculator here. So a dollar in 1988, it took $1.23 in 1993 to equal what a dollar would buy in 1988. So let's go ahead and just kind of go from 2019 until today. So from January of 2019 to February 2024, the increase was $1.23. When you know it. So it's exactly the same now as it was, like basically when after I graduated high school, going out to college, trying to strike out on my own. As a matter of fact, 1993 was when I moved out to England. Now, the problem is it was the years leading up to this. People had it really, really, really good going up, say 2009. Let's just call it 2009 through say 2019. So let's reverse these. So this is kind of what people got used to, but it isn't really the norm over say the history of the nation. So when we look at that from 2009, a dollar in 2009 was still worth $1.20, and it took $1.20 in 2019 to buy what a dollar would buy in 2009. And so this is what people got used to. It wasn't the $1.23 buys what a dollar did 5 years later. It was, we were used to $1.20 buying what a dollar did 10 years later. So it was this rate of inflation is what's got everybody all peaked up. But again, I would say that in 1988, it wasn't that great. So if you take a look at the minimum wage in Las Vegas, it looks like it was sitting at $2.75 for a very long time. When I graduated, it was $2.75. It went up to $3.35 in 1988. And today it's presently sitting at $11.25. So that would represent an increase of 335%. Now let's just see if the cost of living or whatever, has gone up 335% since 1988. So we'll go back over here to our calculator and we'll see what a dollar in 1988 gets you versus today. And let's see if that's $3.35. It's gone up a lot. It's not 335%, but it is 268%. So it's a little worse then than now, but not appreciably worse. Well, let's see. Well, maybe you're thinking, okay, well, what was the rents back then in Las Vegas, right? So the rents back then, I looked up this thing here. It says here in 1990, and this is a little bit after what we're talking about, but this works just, I'm looking at this price. It looks about right. About $650 for an apartment in Las Vegas in 1990. If you were shopping around, you'd get one for about $500. But let's just call it $650 because that's what's on the chart right here. We would say that if you were making the average minimum wage in Las Vegas in 1990, which was what, $3.35, and you wanted to pay for one of these $650 apartments, how much could you do it? So 3.35 times 40 hours times 4 weeks, you couldn't quite get there. You couldn't quite pay for one of these apartments. Like I said, most of them were like $500, so you'll get a roommate or something like that. So it gets you down to about, $250 a month. And then you had a couple $100 extra to pay for like whatever else you could afford. But where is the average rent today in Las Vegas? So the average rent today is $1,457. That represents an increase of, well, I don't even have to do, we'll say it's about 100%. So the increase is roughly 100% over where it was in 1988. Yet the wages have gone up 335%. Talking strictly in a minimum wage sense. And you might say, well, back when I moved out, we didn't have to pay for television. You got like 4 channels and they were free. And our telephone, you kind of like plugged it into the wall, and then you paid like $15 a month. So it wasn't much of a phone bill versus now you get yourself an iPhone, that's a couple $100. So those are differences, but there are a lot of parents that are just paying their children's phone bills and saying, get the hell out of here, get out, I'll pay your phone bill, just go find a place to live. You're making triple what I made, so there's not a lot of sympathy coming from people like me because I remember how I had it and I managed to make it. As a matter of fact, in 1993, I ended up moving out to England. So I was doing all right. And then the other thing is this, if you look at, say, who's getting the raw end of the deal here in this economy today with the inflation that we have right now? Well, here's the Bank of America numbers that they put out here, and they put out this like little survey thing here or whatever. Well, actually, it's not even a survey. It's just they look at their deposits. They're just telling you what's there, and they're saying that the April data represents further signs that consumer spending is softening. Bank of America total card spending per household dropped to negative 1.2% compared with April 22. So the spending is softening. The aggregate labor market picture remains solid, but Bank of America's data suggests some deterioration at the higher end of the income distribution. Unemployment is rising fastest amongst higher income households, while their pay growth is weakest. Higher income spending growth on discretionary items has also fallen below lower and middle income households. So people on my end, we tend to be a little bit more unemployed and spending a little bit less. The good news, however, is that savings buffers remain elevated. Bank of America internal data on household savings and checking balances shows the median balance continues to be over 40% higher than the average in 2019 across all income cohorts. So everybody's 40% has 40% more money in Bank of America than they had just 5 years ago. So this also points to a pretty healthy economy, and there's a lot of money floating around there, which would explain the price of Bitcoin. It would explain the ridiculous price of DWAC. This explains why we're doing so well, and it also explains why this inflation rate is going to have an awful hard time coming down, because we all have jobs, except for the highest income. We all have jobs and we're all spending money. And you might be wondering how this looks over, say, 10 years. You can see that this was a pretty good surge here. But if you go over the max, again, we're going back to like 1987 here. You can see that the inflation was pretty much in line where it is here today. And if you look at it through the late 90s, it did start coming down to the twos. And then in 2000, it went up, and then by 2004, it was 3.62%. But what's got everybody shocked is this sudden rise that went from down here all the way up there. But it's coming back down to where we were here, say, in the 80s and 90s, and it should, in time, come back down to normal. And that's what I think. Now, you might also be wondering, can $11.25 can it buy the $1,465 apartment in Las Vegas today? Well, if you multiply that by 40 and you multiply that by 4, you can see that they're in much better shape than I was, say, back in 1988. They can at least go and get a roommate and then afford other things too, provided their parents are paying their phone bill, which I'm sure they will, just to have them go out and get on their own and, I don't know, buy their own things. So switching gears just a bit and going back to where do I see this market going in just like the near term over the next month, here's the problem that we're going to have is that we're going to have another inflation report that's going to come out on April 10th. And when we look at the year over year reading here, you can see this is an awful flat number right here. And then it goes up pretty good, but then it's flat again. So what this is going to be, because it's year over year, and this line over here needs to be as flat as this line over here. If we get next month a reading of, say, 0.2 month over month, let's see what our reading is in the next inflation print. And to do that, you just take this number here, 311.054, and you multiply that by 1.002, and that gets you that number there. And if you divide that number by this number here, 301.744, we can see that we're probably going to get a little bit of panic in the market, because it's going to go from 3.1% annualized to 3.3% annualized. So this is going to be a problem. That happens on April 10th. Luckily, the earnings don't show up until sometime after. They show up a couple of weeks later, in which case we're going to get a better print as this line is steeper on this end. All right, so that's going to pretty much do it for this week. As you probably figured this out, I grew up in Las Vegas, Nevada, in a time where we didn't have things quite as good financially then as we do today. So But on the market front, I will have plenty of money available to put in the market after my bonds mature on the 11th of April. I chose the 11th of April because that's a day after the inflation report comes out on the 10th of April. But it's also just ahead of the next earnings season, which starts in earnest with JP Morgan and Citi and Wells and how they always does. That happens on the 12th of April. And it gets me in a couple weeks ahead of the mega cap earnings report, which begin on the 25th of April, which is with my favorite stock, which is Amazon. All right, I'd like to thank everybody for checking out the channel again this week. I certainly do appreciate the views, the subs, and all of the support. If you got anything out of this video, yeah, please like, subscribe, hit that notification bell. Until then, have a fantastic weekend, everybody. Bye.